Welcome class to the explanation podcast for the homework answers for fair value or present value. And we'll see some examples of how we would use Excel to accomplish these calculations. So the first one is Archer Company, looking at the value of the bonds. Instruction about value of bonds is there the present value of the future cash flows. So you can see the formula here. We use the present value of 4%, and because they're twice a year, we divide that by 2. Number of periods 20, number of times that they're going to make a payment. The payment is calculated by taking the $2 million face value times 0.043, the coupon rate, and dividing it by 2. And then the maturity value, or the amount that's going to be paid off on the bonds at the end, is this future value, FV. And that gives you the value of the bonds on the sale date. Payments was calculated inside there as well. Now in 2016, you've made 6 payments, and so there's 14 payments left. And so the question is asked, what would they be worth? What's the value of these bonds in 2016? You use the present value again, but this time you use 5% because what has happened, the change in the market rate. Number of payments left is 14, so it's only worried about how many are in the future. Payment is the same as it was because that doesn't change, and the maturity value is the same as well as we did earlier. So that's how you calculate that. You can see that's negative. If you don't like it to be negative, you can just put a minus sign in front of the equal sign and change that to a positive number. Okay, number 2, we're looking at a loan and figuring out the payments on this. And I asked you to calculate the payment for an annual basis, quarterly basis, and a monthly basis. And so the payment is, we use the PMT function, all right, and we use 5.5% or 0.055. Number of periods is 10, and the amount of the loan is $850,000. So your annual payment would be $111,000. Quarterly, notice the difference in our formula, how we do it. We take the 5.5 divided by 4, and we take the number of periods multiplied by 4. Other than that, it's the same. And then monthly, you're going all the way to 120 payments, and you're dividing the interest rate by 12. And just for kicks, we look at what it would be if you took that times 4. So you see the annual payment is 112. The quarterly payment is just over 111. Total cash out in the year, and the monthly payment is lower still, and that's because you pay off the principal faster, and therefore you pay less interest if you do it on a monthly basis versus a quarterly versus an annual. All right, so 2 sides of the transaction. One side right now is buying equipment. All right, the other side is selling equipment. Now the key thing here, remember, is that the agreement is not to pay cash, but to pay money later, not cash up front. All right, so the idea is, in accounting terms, there's no such thing as 0 interest. So we treat it as if there was interest, even though it is not stated. And even if there is an interest rate and it's not high enough, then we would treat it as if it was high enough and compute the difference. But in this case, it's 0. So the equipment, the thing we have to look at is a present value again of two payments, 200,000 at 8%. So that's not 400,000, it's 356. Paid cash of 50. So the total equipment is the present value of those future cash flows. Same thing on the seller side. Their note receivable or account receivable is for that, should match. And the revenue should be the total of the cash received plus the future payments, so the present value of those future payments. Then as time goes by, you record interest and liability for part of the year, because this was a kind of straddles the years, if you will, here. All right, so you do interest for the end up to the end of the year, and then for the first part of the year. Now you can credit the interest payable or a liability. The original liability, the same account. But when you pay it off, then you debit the liability for the full 200,000. So you're paying off this part of the liability, this part of the liability, and reducing the amount of the original liability. If you put these as interest payable, then you would debit interest payable for the sum of these two, and then the rest would go to the liability. And just the opposite over on the other side with interest receivable or note receivable and interest revenue. Do a second in the next year, same process. Okay, the new balance is now 100 after the payment was 185,000. So you got to calculate your interest based on that. The interest expense, liability, same accounts. This for the rest of the 7 months of the year, the first 5 months of the next year, and then if you've done that close enough, you should have the new balance plus these interests should equal 200,000. You pay that in cash. If you recorded this as interest payable, then you would debit interest payable for the sum of those two, and the rest would be the pay off the loan of 185. Same thing on the receivable side. The last one is Harvey looking at acquiring a new business. These are the future cash flows. They are uneven, so you cannot use present value for those cash flows. You have to schedule them out on your spreadsheet like this, and then you can use what we talked about, net present value. Put in the interest rate and then the cash flows, and that will tell you, that takes each of these payments and figures out the present value of each of them and then adds them up all in one fair swoop. So this is assumed to receive at the end of 2016, end of 2017, 2018, and so forth. And then each one of those is the present value at a 15% interest rate. That means that this business would be worth $4.77 million, and you would not pay any more than that. You would be certainly willing to pay less, but you would not pay any more than that to get access to these future cash flows. So that's what they're worth at a 15% rate. And if you change the rate, then that would change what they are worth as far as their present value.